What are debt restructuring methods for sovereign debt? Imagine a country struggling to pay back its loans, facing the risk of default. How do they manage to keep their economy afloat and avoid a crisis? That's where debt restructuring comes into play. Countries use different methods to modify their debt agreements, making repayment more manageable. These strategies help restore financial stability and prevent economic collapse. One common approach is debt relief, where creditors agree to accept less money than owed. This is called a haircut, and it reduces the total debt burden. Countries might also extend the time they have to repay their loans, known as extending maturities. This gives them more breathing room to meet their obligations without immediate pressure. Lowering interest rates is another method, which cuts down the cost of servicing the debt, making payments more affordable. More specific techniques include debt buybacks, where the country repurchases its debt at a discount, reducing the total owed. Debt for equity swaps are also used, where debt is exchanged for ownership in government-owned businesses or assets. This turns debt into a stake in the country's economy. Bond exchange offers are common too. Here, creditors are offered new bonds with different terms, such as lower principal, reduced interest, or longer payment periods. These offers often include a menu of options, allowing creditors to choose what suits them best. Another tool involves exit consents. This technique lets the country ask creditors to approve changes to old bonds, making it harder for holdout creditors to block restructuring plans. Countries can also restructure debt either before they default, called pre-default restructuring, or after a default has occurred, known as post-default restructuring. The latter can be more complicated and often involves more negotiations. Sometimes, debt restructuring is combined with economic reforms aimed at improving the country's financial health. For example, the Brady Plan in the 1990s used debt haircuts along with reforms to help countries attract investments again. Historical cases like Germany after World War II or Russia in 1998 show how these methods can help countries recover from financial crises. In recent years, the process has become more organized, with countries consulting creditors, issuing detailed proposals, and offering clear options. This helps ensure everyone is on the same page and the process moves smoothly. Overall, sovereign debt restructuring methods are diverse, combining debt reduction, extended payment terms, lower interest costs, and sometimes exchanging debt for assets. All these efforts aim to help countries regain stability and continue their economic growth.